Inflation was worse than anticipated for the fifth straight month, according to data released Wednesday morning, as lingering price increases throw a wrench in plans for eagerly awaited interest rate cuts. Just like with stocks around earnings reports, the reaction of 10-year yields to the CPI release is arguably more important than the release itself, Morgan Stanley strategist Michael Wilson explained to clients earlier this week. Bond yields climbed last week to their highest level since November as the market increasingly priced in a scenario in which the Federal Reserve keeps interest rates higher for longer than previously anticipated. The roughly 4.4% yield for 10-year U.S. Treasury notes is about twice as high as it was 2 years ago when this bout of inflation began taking hold, indicating a significant shift in long-run expectations for U.S. monetary policy. If higher crude oil and gasoline prices upend the downward trend in inflation, oil benchmark Brent Crude is up about 20% year-to-date amid escalating military conflict abroad, and U.S. gas prices hit a 6-month high this week. Worrisome developments considering surging energy prices strongly contributed to the rapid increase in inflation in 2021 and 2022. But even after the recent uptick, oil prices are well anchored and consistent with the Fed's inflation goals, according to Bank of America strategist Meghan Swiber, who noted that oil prices remain nearly 30% below their 2022 peak shortly after Russia invaded Ukraine. Headline CPI inflation crested at over 9% in mid-2022, hitting its highest level since the early 1980s before recovering to today's far more palatable rate. The decline in inflation came as the Fed bumped interest rates to levels not seen in 2 decades in a bid to restore price stability. Though higher rates help bring down inflation, they also tend to slow economic growth and cause stock prices to decline, though the U.S. economy and stock market has proven resilient this economic cycle. Despite the moderation in inflation, American spending power is weaker than it was 3 years ago, as hourly wages have increased 15% as the cost of the basket of goods and services tracked by CPI rose 18%. CPI reports often bring significant volatility in the market, evidenced by the S&P moving more than 1% on 3 of the last 5 CPI release dates. Not everyone is a fan of the significant attention paid by the market to all inflation-related minutiae. There seems to be an enormous focus, too much so, on monthly inflation data, rather than on the big picture. Jamie Dimon, chief executive of the largest American bank, JPMorgan Chase, wrote Monday.